For David D'Ambrosio, I'm Connor Herbart, and we investigated banking and the economy in China. First, we did the standard banking rates. We found that it's about 3% interest rate on a 1-year time deposit account, which is what most banks tend to offer since they are government owned. We found it's about 0.5% interest rate for savings accounts, and we found that there's a 6% interest rate for loans and mortgages. Next, I did a little research on the economy. China's economy seems to be in the process of ending its record-long growth. They have had great amounts of growth, including monetary inflation, increasing exports and development. However, this has had a negative impact on the domestic economy by making domestic goods cost more, and they're exporting most of what they produce, leaving the Chinese citizens living in poverty. China will go through recession shortly, according to the Austrian business cycle theory, which states that when there is a massive monetary inflation, an artificially low interest rate causes unsustainable booms. Li Keqiang has said that a 7.7 increase in GDP would create about 10 million new jobs for Chinese workers. However, the number of increasing jobs is more like 2.8 million. Because China is producing less and less jobs, it is going from a slow growth to a state of contraction. Next, we looked at the attitude toward foreign businesses in China, and I found that Chinese businesses tend to be more zero-sum competition-minded with other companies, and that could cause problems for foreign businesses trying to do business with their Chinese counterparts. Also, most growth coming from business in China in the last 40 years has been from small and medium-sized private businesses. And policymakers and government officials in China are more interested in establishing their own multinational enterprises than foreign enterprises. So the percentage market share in all industries for foreign companies is most likely to decrease as this starts to happen.
Now let's talk about the competitors. The biggest competitors in the Chinese banking industry are the Big Four. They comprise of almost 50% of the industry. The Big Four are as follows: Industrial and Commercial Bank of China, China Construction Bank, Bank of China, and the Agricultural Bank of China. Notice these banks are all ranked in the top 10 globally and have a big jump on the competition in total assets. The other notable banks in China are the Chinese Development Bank, Bank of Communications, and the Postal Savings Bank of China. These banks are significantly smaller than their Chinese counterparts, but still hold a strong hold in the total assets department. Along with the banking giants in China are many locally operated banks. These are very similar to the big state-owned banks, but are on a much smaller scale. These banks are meant to serve local communities and small to medium enterprises. There are also 3 other U.S. banks in China: the Bank of America, Wells Fargo, and J.P. Morgan. These banks are also ranked in the top 50 globally based off of their total assets. In recent months, China has announced the opening of 5 private banks. These banks are to target and lend money to small and medium-sized enterprises. The new banks will follow the same rules and regulations as the state-owned banks. Although the banks are waiting for private investors, they are expected to be opening within the next couple of years. The private sector of banking only accounts for 12% of the total banking industry in China. Along with the opening of these banks, the Chinese leadership is pushing through reforms that are said to liberalize the interest rate in the banking industry as a whole. Now let's look at the market shares. As you can see, the equitized banks make up more than, or almost 50% of the market. These would make up the Big Four. The other state-owned banks make up pretty much the rest of the industry, with foreign banks only holding a 1.8% share. Take note that these numbers are for the end of 2010, but I assure you the numbers still hold strong today. Now let's talk about the structure. Now let's talk about the banking structure. Over the past 30 years, the Chinese banking structure has been going through significant changes. It wasn't until the 1970s that this change started to occur. During this time, the Chinese banking system moved from one government-controlled bank to multiple government-controlled banks with the People's Bank of China as the central bank. Today, these banks still exist, but only 3 remain completely state-owned. The banks that used to be state-owned are now owned by a variety of different investors. Although these banks may be owned by private investors, the central government still has a great influence over the banking sector. In recent years, the Chinese government has been pushing through reforms. These reforms are said to make the banks more commercially competitive and open up the Chinese banking industry to foreign and private ownership. Another thing to watch for in the Chinese banking industry is shadow banking. This is basically underground illegal banking. These banks can be favorable because the deposit rates are higher and they do not disclose any information about your assets to anyone. They also will loan money to those who otherwise would not qualify for a legal loan in the regular banking system.
All right, that was everything we were able to find. We hope it helps you a lot in your project and making your decision about whether or not Citibank should stay in China. Thanks for listening.